Professor, good to have you back. Good morning.
Good morning.
All right. So what about the glass are you seeing that is half full?
Well, I don't think there'll be any debate from anybody that these are all great businesses. They've got almost no debt, huge cash balances, solid pricing power, and they're cash machines. I think the question always was at what price would you get in? And when I valued them 3 weeks ago, I think I found 3 overvalued and 3 undervalued, but that was 3 weeks ago. And in the last 3 weeks, prices have dropped enough that 2 of those 3 have made it into my portfolio. So at the right price, I think these companies are great additions to a long-term portfolio. It doesn't mean in the short term that you won't have some pain. But I think in the long term, I'd rather have these companies than pretty much any consumer product company because of the combination of good stuff that they bring to my portfolio.
Interesting. Now, is the most recent re-rating lower, do you think, being pinned to a black swan event related to what we're seeing around the world?
I think that's, part of it is that black swan event, the worry that this could be something potentially catastrophic that's hanging over. Part of it is I think investors are getting a chance to reassess. I've always said that corrections come with catalysts. And sometimes the catalysts are distant and sometimes they're near. And I think that this might be an occasion for people to take a look and ask, what the heck have we been doing? Because pushing up the prices of some of these companies to levels, I mean, you can take the Zooms and the Pelotons of the world and think about how much we pushed up the pricing. And sometimes you need a reminder that you've overdone things. And I think investors are using this as a chance of cleaning up some past mistakes.
Aswath, good morning. It's Deirdre. You'd rather have some of the big tech names than any others and sort of the consumer-facing names. But, are you really going to make the same kind of returns? Is Apple going to double again, or Microsoft? I wonder, what do you think for some of the higher growth names where there may be earlier opportunity, or has that already been washed out in the valuation compressions we've seen over the last few months?
You know what? In this market, I'll take a 10% return every year. To me, that would be a good return. I think reaching for companies that are going to double, I think, is a pathway to making mistakes here. I think when the market's priced to earn 6-7% returns, if you can make a 10% return on these tech companies, that'll be amazing. I'll take that.
Aswath, and what about M&A? We're talking about some of these names that have held up better than others, Alphabet being one of those, though it had a rough go for a while before that as well. And it's snapping up Mandiant for just over $5 billion if this goes through as they hope it will. What's the significance of some of the more dramatic drops we've seen, perhaps in software and enterprise software, and some of these larger cash-rich companies having resources? Is M&A part of what's going to drive that 10% return that you're hoping to see?
Yes, and you can make money on the other side too. I happen to own Peloton, not because I have great belief that they can turn their business model quickly, but because I think they're going to get acquired. That I think, many of these promising tech companies from last year and 2 years ago that were selling at, premium prices are now at prices where, let's face it, with $200 billion in your balance sheet like Apple does, if they wanted to, they could buy just about anybody they want. So I think that some of this 10% return is going to come from snapping up companies at bargain basement prices.